miners, you point out, were one of the major reasons we couldn't hold that high today. So why did we see those dragging?
I guess if we have a look at the market, we've seen the same type of trend over the last few sessions, and that is that the US market tends to impact on how we open, and in the afternoon we're impacted by how China trades. And if we have a look at the market today, we were down by 0.1%. If we have a look at the intraday graph, you can see we were off to a pretty good start in the morning with the US stock market up 0.6% overnight. But once the Shanghai Composite came online, we did see a bit of a rocky start, and at one point it was down during the session, although it's looking pretty flat at the moment. So that uncertainty really leading to a little bit of uncertainty on the Aussie market as well. And I think the miners have a big part to play. BHP down 0.7%, Rio Tinto down by 1.3%. Now both of these stocks actually go ex-dividend next week, so you'd expect a bit of buying into the ex-dividend date to get that dividend, the very attractive dividend, by those two stocks. But unfortunately we are seeing that the very low iron ore price at the moment is impacting on those iron ore stocks, and we've actually seen the spot price for iron ore at the lowest level since July 2013. So while we've seen some good earnings coming through from that material space, that iron ore spot price continues to drag. And of course today was all about earnings as well. QBE Insurance up 5.3%, Cabcharge up 6%, Flight Centre up 1%, so some good performances out there. But all in all, I think just a little bit of nervousness, and the miners unable to pull their weight today, saw our market losing 0.1%.
Noticed though a couple of analysts pointing out that the insurance margins were still below the target set back in December when we saw a downgrade because of net claims.
The insurance margin is of concern, but I guess if we have a look at QBE's result, really no new surprises here today, and that was seen as a positive, and also flagging improvement. We know what QBE's problems are. They were well flagged back in December and well outlined. The collapse that we saw in corn prices over in the US, the regulatory crackdown that we saw in terms of home insurance, and the problems in North America. And it does look like there's now a new key management team there, and now it's all about rebuilding and restructuring those North American operations. Also, technically, we've been here before a number of times, and if we have a look at QBE's share price, this is a 5-year share price for QBE Insurance. And if I just zoom in maybe on the last 3 years and have a look at what's happened here, you'll notice that a few times we've reached a floor around that $10 mark. And once we've reached that floor around the $10 mark, usually we go back to at least that $15 mark. So I guess a lot of technical traders asking themselves whether we're going to be third time lucky. We did see that $10 floor once again, and whether we are going to see that first target of $15 once again. So technically we've been here before, just watching to see if it happens for a third time. In terms of these results, no new surprises, and QBE Insurance flagging improvements. So I guess the share's doing quite well today, up by 5.3% after that massive tumble that we saw in December.
By the close, it came in above most estimates. Impressive revenue growth there in the first half of about 10%. What did you make of this one?
It was a great result from Ramsay, and it does show that the demand for quality hospitals does remain strong. Most of their revenue is derived from their Australasia portfolio, which mainly consists of the 69 hospitals in Australia, although they do have a presence also in Malaysia and Indonesia. But we saw strong revenue growth coming through. They of course also have a presence in the UK, and it does look like there's going to be a very strong focus on growth. They are looking at more overseas acquisitions, and also $100 million in terms of construction. Not only that, we saw an upgrade to full year expectations, so expecting to see growth of 16 to 18%, and that means more broker upgrades are on the horizon tomorrow morning. So Ramsay Health Care, the stock price actually reaching the highest level that we've ever seen for Ramsay, so an all-time record high, and the stock up 6.7%.
If this company losing about 4.8% on the market today, what was driving that share price down?
Money managers are doing really well at the moment. We've seen the market up 8% over the past year. If you include dividends, the market's up 12%. So they've been riding the market returns. We're seeing fund inflows coming through, and we've seen that coming through for IOOF. So we've seen underlying profit up by 14%, revenue was up by 12%. So all these numbers look very good, but during earnings season, it's not just about growth, it's about expectations, and the market was expecting to see more. So we did see IOOF, although it did come out with some very good growth numbers, it missed market expectations by around about 5%, and its share price also fell by about 5% today.